Silver just snapped a lot of people out of their sleep, and it's about to test who actually understands what's happening versus who's just staring at a number on a screen. Because yeah, silver is flying. But the price is the least important part of the story, until the moment it suddenly becomes the only thing anybody can talk about. And that moment might be closer than most people think. It's Tuesday, January 27, 5:38 a.m. New York time as I'm recording this. Comment what time you're watching right now because I'm curious how global this move has become. Quick thing, I'm running a campaign to eliminate copycat channels. If you value what I do here, hit subscribe and comment Our John AG to show support. Also, check the description when you're done. There are bonus links, including a premium WhatsApp channel link and a channel membership join link. Now, I'm going to say something that's going to sound insane to people who only started paying attention this week. If silver is sitting around 100 plus and you're asking, is it too late? My answer is, the market hasn't fixed the real problem yet. Not even close. And that's why the next part matters. I took a breather after the chaos at the end of last week. The kind of move where every group chat turns into a scoreboard, every headline turns into a victory lap, and every expert suddenly acts like they predicted it all along. But here's what I noticed during the noise. Nobody can tell you where silver goes next. Because the thing that normally sets the price isn't really a price discovery mechanism. It's a pressure valve. It's futures, options, leverage, and games, where the biggest players can lean on the market when they need to and let it run when it benefits them. And before somebody clips that and says I'm claiming silver can never dip again, relax. It can dip. It can get punched in the face on a random Tuesday morning. That's the whole point. The question isn't, can they smack it down? The question is, can they smack it down without triggering the problem they're terrified of? Because while paper can be created in infinite quantities, physical metal can't. Here's the mechanics in plain terms. On the future side, most positions never end with a truck showing up with metal. They end with people closing, rolling, or settling in cash. That's normal. That's how leveraged markets survive. But it also means price can be pushed around by players who aren't trying to own silver at all. They're trying to control the narrative, the flow, the options positioning, the margin dynamics, the headlines. When the market is calm, that game works. When the market is stressed, the game becomes dangerous. Because the one thing the paper system can't tolerate is too many people choosing delivery at the same time. Not some, not a few, too many. And none of the structural issues that have haunted silver for years have magically disappeared just because the price had a few wild days. Manufacturers still need silver. Solar is still a silver story. Electronics are still a silver story. Electric vehicles are still a silver story. Medical uses, data centers, power grids, defense tech, silver is everywhere, even when people don't want to admit it. Think about it like this. Silver is the grease in the machine of modern life. It's in switches, connectors, coatings, solder, pastes, sensors. It's in the stuff you touch and in the stuff you never see. And even if companies thrift and reduce silver per unit, the world keeps adding units. More devices, more infrastructure, more energy hardware. You can shave grams, but you can't shave the need to conduct electricity cleanly and reliably. From recent market updates, solar installations keep scaling and the industry keeps pushing new cell designs. Some designs use less silver per cell, sure. Others move the silver around differently, and some of the next-gen tech can actually be silver-hungry depending on how it's implemented. The point isn't which model wins next quarter. The point is the direction. More energy hardware equals more silver draw. Now layer in EVs, charging networks, and the grid upgrades required to handle all of it. That's not a one-year trend. That's a multi-decade build-out. And here's the part that doesn't get talked about enough. Most silver supply doesn't come from silver mines in the way people imagine. A huge chunk comes as a byproduct when companies dig for other metals. That means even if the price spikes, supply can't instantly surge the way people assume. Projects take years. Permits take years. Equipment, labor, financing, years. If base metal miners cut back because copper or zinc margins get squeezed, silver supply can tighten even if silver's own price is screaming higher. That's one of the weird paradoxes of byproduct metals. The supply lever isn't directly connected to the silver price lever. Recycling helps, but recycling isn't a superhero. It depends on collection systems, economics, and the fact that a lot of silver is dispersed in tiny amounts across billions of products. There's a difference between recycling a big bar and recycling microscopic dust spread across consumer electronics. So when demand shifts fast, the market doesn't politely adjust. It snaps. And right now, demand is shifting in a way that feels like a switch got flipped. For years, it was mainly industry quietly pulling metal out of the system. Then investors started circling it again. Not necessarily the average person walking into a shop. I'm talking about bigger pools of capital that move slow until they don't. And when they do, it's not a buy a few ounces situation. It's a clear the shelf, then ask what's in the back situation. And that's why you're hearing the weird stories. I tried to sell and they offered me way under spot. I called around and nobody wants my silver. They're acting like it's not even valuable. Let me translate that into plain English. If somebody is offering you a ridiculous lowball price in the middle of a market that's ripping, that's not a sign silver is weak. That's a sign they're weak. A lot of small dealers run on thin capital and credit lines. They don't want to be stuck holding inventory if the market swings violently against them for even a day. And when banks tighten up, the first thing that gets squeezed is the little guy's ability to float inventory. So some of them protect themselves by widening spreads like crazy, meaning they bid low and they ask high. It's not personal, it's survival. Also, some shops hedge. They'll buy from you, then immediately try to offset risk in the paper market. When the paper market is whipping around, that hedge gets expensive. So they price in the chaos by cutting bids. Again, it's not about silver being unwanted. It's about them not wanting to get caught in the crossfire. But you have to understand what game you're playing. If you're desperate for cash, you do what you have to do. I'm not judging anybody's life. But if you're not desperate, selling your metal for a panic discount to somebody who's undercapitalized is like handing your winning lottery ticket to the guy at the gas station because he claims he can't make change. Here's a better move. Start with your own circle. Friends, family, coworkers, neighbors, people who keep asking you, "So, how's that silver thing going?" If you need liquidity, offer them a fair deal at spot. You get cash, they get metal, and you cut out the middleman that's tied to the same financial system that's trying to keep everything under control. And yes, that's where I think we're headed anyway. Less everything goes through institutions, and more people dealing directly with people. Because when volatility hits, institutions protect themselves first, always. Now, I've also been hearing the other side of it. Inventory is getting tight, online listings flipping to out of stock, wait times stretching out, back orders. And you have to be careful there too. In a fast market, the worst thing you can do is buy something that doesn't exist yet. If you're placing an order with a promise of delivery weeks from now, you're not buying metal. You're buying somebody's ability to source metal later. That's not the same thing. If you want physical, prioritize what's actually in inventory. If your local shop has real product in the case, that's real. If a seller can show you they have it in hand, that's real. If it's a, "we'll get it to you when we can," that's a different kind of exposure. And I'm not saying every back order is a scam. I'm saying during a squeeze, delivery timelines become the story. And if you don't pay attention to that, you'll think you own something when you actually own a promise. Now here's the twist that catches people. In a panic, the cheapest price on the internet can be the most expensive decision because it can come with the biggest uncertainty. When the dust settles, the metal you can hold is the metal that counts. And that leads us to the most important metric right now, not the dollar price, the ratio. The gold to silver ratio is still sitting in a range that screams unfinished business. Even with silver exploding, 1 ounce of gold is still buying a wild number of ounces of silver compared to plenty of historical periods. And this ratio matters because it's a rough map of relative scarcity, relative demand, and relative monetary premium. Silver is the workhorse metal. It gets consumed. It gets embedded into products. A chunk of it is gone forever unless it's recycled. And recycling isn't magic. Collection and processing have limits. Gold, on the other hand, is hoarded. It doesn't get used up the same way. A lot of it stays above ground, in bars, coins, jewelry, vaults. That doesn't mean it's cheap. It means it behaves differently. So when someone tells you the ratio can only go one way, be cautious. Ratios can overshoot. They can snap back. They can stay weird for longer than anyone expects. We've seen extremes in both directions. We've seen moments where silver got treated like a forgotten industrial scrap metal, and moments where silver got treated like money that people suddenly remembered they needed. And the way the ratio moves is rarely smooth. It's usually violent. Here's the wave pattern. First wave, silver runs and people call it a fluke. Second wave, silver runs and people start asking, "Wait, is this real?" Third wave, silver runs and the public shows up late, emotional, and loud. And right now, we're somewhere between the first and second wave, which is why you're seeing confusion everywhere. Now you'll hear people say, "We hit around 30 to 1 before." Sure, we've seen compressions like that in modern times, usually around moments when money was losing trust and people were desperate for hard assets. We've also seen the ratio go much lower in older, more extreme episodes, times when silver's monetary role surged and the market structure looked nothing like today. And we've seen the opposite too, times when the ratio blew out to levels that felt absurd, because fear and liquidity preference made gold the default refuge while silver got ignored. That kind of blowout can happen fast, and it can unwind fast. But I'm going to give you a counterpoint that a lot of silver bulls don't like hearing. The idea that silver must go to 1-to-1 with gold isn't a law of physics. It's a thesis. And if you're going to build your entire strategy on that thesis, you need to understand what would have to be true for it to happen. It would require a world where silver becomes primarily monetary again, not just industrial. It would require massive repricing, not just of silver, but of trust itself. It would require a level of panic and reallocation that changes how people store value. Could that happen? In a chaotic world, weird things happen. But my point is, don't anchor your brain on a single magical endpoint. Anchor it on the mechanics. The mechanics are simple. Silver supply is tight relative to growing use cases. Demand can surge faster than supply can respond. And the paper market can only manage that imbalance until it can't. That, until it can't, is the cliffhanger nobody can time, and the reason I still prefer owning real metal to betting on a price chart. Now let's talk about the elephant in the room that's coming up more and more in recent market updates: strategic stockpiles. Governments don't talk about stockpiling a material because they think it's boring. They talk about stockpiling because they're worried about access. And when you start hearing that kind of language, supply chains, critical minerals, national security, it means demand is about to get less price sensitive. Translation: they'll pay up. And if multiple countries decide they need their own pile, at the same time, you don't just get a higher price, you get competition for the same limited physical pool. That's when the market stops acting like a market and starts acting like a scramble. Because strategic buyers don't care about your chart. They care about guaranteeing supply for factories, for defense contracts, for infrastructure projects. And if the message becomes secure first, negotiate later, premiums can detach from the screen price faster than people believe. Now, let me bring this back down to street level, because this is where people actually make mistakes. In volatile moments, people do something emotional. They sell to whoever is standing in front of them first. That's why I keep repeating the same rule. If you're not forced, don't dump real metal for a discount just because someone tells you nobody's buying. If nobody's buying, why are they trying to buy it from you? Think. And yes, there are weird corners of the market, older coins, mixed bags, fractional pieces, where premiums can swing, and sometimes you'll see things trade near melt value or even under it. That happens. It's a liquidity thing. It's a sorting thing. It's a trust thing. But clean, recognizable bullion getting offered at some dramatic discount in a frenzy, that's usually not a silver problem. That's a dealer problem. Now, I want to pivot into something that a lot of people think is boring, but it's where the fingerprints show up: chart mechanics. For years, one of the classic games in metals was the moving average trap. Push the market under the big lines, trigger the technical selling, scoop liquidity, repeat. And I'm not saying technicals don't matter at all. They do. There are funds and algorithms that obey those levels like a religion. When price crosses certain lines, money moves automatically. It's not emotion, it's rules. But what's happening now is the trend is moving so fast that the old control points are chasing the price instead of guiding it. The longer-term averages are rising, but they're still far below the current action. That's a big deal, because it changes how much room there is to slam without causing a real panic for the shorts. And it changes something else too. It changes psychology. When a market runs far above long-term averages, every dip looks like the dip, and every dip attracts buyers who missed the first run. That's how momentum builds, not in a straight line, but in waves. Which brings us to the positioning data. There's a report that comes out that basically forces banks to show their broad footprint in the silver futures market, how much they're short, how much they're long, and whether that exposure is domestic or foreign. And the headline everyone loves is, "Look, this group is net long." But net is the most misleading word in finance, because net can hide a bomb. If you're long in the distant months and short in the front months, you can still get destroyed if the front month demands delivery. If you're long on paper, but your short is concentrated where delivery risk is highest, net long won't save you. And that's the part I think people miss. Time matters. A contract expiring soon is not the same as a contract expiring later. So when I see overall positioning that looks balanced, I'm not comforted. I'm curious. Because balance on paper can still mean chaos in reality. Also, concentration matters. If a small number of players hold a huge share of the short side, the market can look fine until one of those players blinks. And when a concentrated short blinks, price doesn't politely rise. It gaps. Now, another piece of the puzzle is open interest. And I want you to picture what open interest really is. It's the number of outstanding promises in the system, longs matched with shorts. When it climbs while price climbs, it often means new money is entering the trade. But it can also mean the other side is doubling down. And when open interest surges, it tells you the fight is getting bigger, not smaller. We're watching insane paper volume, amounts of silver represented on paper that dwarf what actually moves around physically on a normal day. That doesn't automatically mean fraud. It means leverage. It means a casino-like structure sitting on top of a very real industrial commodity. And casinos work fine, until too many people ask to cash out at the same time, which takes us to delivery. Every month, there are contracts that can stand for delivery. In some months, it's quiet. In some months, it's loud. And lately, it's been getting louder even in months that are supposed to be calm. That's a signal. It says more participants are refusing to just roll paper forward, and instead are saying, no, show me the metal. And when that becomes normal behavior, the system has to either source physical, pay people off to go away, or rewire the rules. Those are the only options. Now, when people hear delivery, they imagine one simple thing. Metal leaves a vault and goes to a buyer. But inside these exchanges, there are layers. There's inventory that is technically sitting in approved warehouses, and then there's inventory that is actually committed to satisfy contracts. Not everything that exists is available. Some is already spoken for, some is owned by someone who has no reason to sell, and some is there in name only until paperwork turns it into deliverable stock. That's why you can get situations where the screen price looks calm, while the real-world premiums are screaming. The market is whispering, we have silver, while the physical market is shouting, prove it. And one of the best stress signals is when the cost of borrowing silver in the short term starts acting weird. Sometimes the near-term price can lift above the later months, basically paying you to deliver now instead of later. That's not normal in a well-supplied market. That's the market saying, immediate metal is worth extra. If we start seeing more of that kind of behavior, it's a warning light. Not a guarantee, not a prophecy, just a warning light that the system is getting tight at the exact point where it's supposed to be liquid. And here's the part most people miss. Tightness doesn't have to be total to matter. You don't need no silver anywhere for a squeeze. You just need not enough silver at the right place, in the right form, at the right time. That's how a plumbing problem becomes a headline problem. So when someone tells you, relax, it'll all roll over. Remember, rollovers work until the crowd refuses to roll. The moment enough buyers say, I'll take mine, the pressure shifts from charts to logistics. And logistics are not infinite. That's why I'm watching behavior, not bravado, because the behavior is where the next surprise will show up. When that surprise hits, it won't announce itself. It'll hit like a gap move, and you'll feel it in premiums first. Now here's another under-the-radar detail. Exchanges have been introducing smaller contract sizes to pull more people into silver exposure. It sounds good. More access, lower capital needed. But it also expands the number of paper claims. And in a stressed market, expanding paper claims doesn't solve scarcity. It just changes how the crowd interacts with scarcity. This is why I keep telling you, the day-to-day price is entertainment. The delivery behavior is the plot. Because if delivery demand keeps accelerating, you hit a tipping point where the market can't pretend it's business as usual. And once that happens, you stop knowing the price of silver the way you do now. You get fragmented pricing. Different prices depending on where you are, what form you want, how fast you want it, and who you trust. That's when people who only owned exposure realize exposure is not ownership. Let's talk about that because I know it's sensitive. A lot of people own paper silver products because it's convenient. You click a button, you get price movement. You don't have to store anything. But convenience comes with a hidden trade, counterparty risk. If you don't have the metal in your possession, you're trusting a chain of entities, brokers, custodians, banks, vault operators, clearing firms. And in stable times, that chain feels solid. In unstable times, chains break at their weakest link. And the more links there are, the more ways there are for you to hear, sorry, that's delayed, or sorry, those rules changed, or sorry, we settled in cash. That's why I tell people to be honest with themselves about what they own. If you own exposure, call it exposure. If you own metal, call it metal. And if your plan is, I'll convert exposure into metal later, just understand, later is when everybody else tries to do the same thing. Now, there's another storyline that's starting to creep into this conversation, and it ties into geopolitics without me having to name any politician. When major powers start talking about securing resource supply, whether that's through new trade deals, new refining capacity, or new strategic reserves, it's a reminder that metals aren't just investments. They're inputs, they're leverage, they're power. And silver, because it touches electricity and technology, sits right at the center of that. So when you hear about new refining projects, new industrial policy, new critical material lists, don't yawn. That's the quiet setup before the loud scramble. Now, I want to go somewhere that might seem like a detour, but it matters for mindset. People love to say, there's plenty of gold above ground, or there's hidden gold nobody knows about, or there's secret stockpiles. Some of that is probably true. Some of it is rumor. Some of it is mythology that gets recycled whenever markets get emotional. Here's what I'll say. There are definitely places on Earth, temples, family vaults, cultural hoards, where precious metal sits outside the financial system. And sometimes stories about those hoards are exaggerated, sometimes they're understated, and sometimes the truth is we just don't know. I've gone down that rabbit hole myself. You see photos of structures that look like they're glowing. You read about rooms sealed for centuries. You hear claims of caches found and caches never opened. And you realize something. Information is uneven. But even if there's more gold than the public expects, that doesn't automatically kill the gold thesis. Because price isn't just about quantity, it's about willingness to sell. And people don't sell their last resort asset easily. So when someone uses hidden supply as an argument to dismiss the whole market, I'm skeptical. At the same time, I'm also skeptical when people use hidden supply stories to promise guaranteed ratio outcomes. The truth is, uncertainty cuts both ways, which is why I prefer focusing on what we can see: consumption, production timelines, inventory behavior, and delivery stress. Now, let's shift to something else that popped up in some corners of the internet recently. A niche legal battle in the digital asset world that could become a template for how the next era of finance gets built. I'm not talking about meme coins. I'm talking about the concept of tokenizing assets, turning ownership rights into on-chain tokens, automating settlement, compressing middlemen, and basically doing to finance what streaming did to cable. Based on the latest publicly available filings and court calendars, there's a case where a project's assets were seized years ago, and now the argument is about what happened to those assets, who controlled them, and whether the handling of them violated the rules. And the reason I'm bringing this up in a silver video is simple. It's the same theme: paper claims versus real ownership. When you own something directly, you control it. When you own something through a structure, you're trusting governance. And governance gets ugly when stakes get big. Now, if that case breaks a certain way, it could do two things at once. One, it could set precedent for how intellectual property interacts with tokenized markets. Two, it could remind everyone that confiscation risk and custody risk aren't conspiracy theories. They're part of the real world. And as finance moves toward tokenization, these fights over custody and control will multiply. Also, tokenization isn't theoretical anymore. You can already see traditional institutions experimenting with token-like settlement rails, faster transfers, and programmable ownership. Some of it will be good, some of it will be used to tighten control. And that's why these early court fights matter. They draw the boundaries. So, if you ever wondered why I'm obsessed with owning real things, metal you can hold, land you can touch, skills you can use, that's why. Systems change. Ownership endures. Now, I'm going to tie all of this together with a simple, uncomfortable question. What happens if we get one more leg higher in silver and the mainstream crowd shows up? Because right now, a lot of retail people are still not engaged. They're confused. They think it's a spike. They're waiting for a pullback that feels safe. But the moment the average person feels FOMO, the product that vanishes first isn't futures contracts. It's small physical. It's coins, rounds, bars, the stuff that can be carried, stored, gifted, traded. And that's when premiums go nuts. That's when you hear, "We can't quote that right now." That's when you see rationing. That's when the story goes from "silver is up" to "silver is hard to get." And that's why I keep telling you to think in terms of availability, not just price. So here are two questions I want you to answer in the comments. First, are you actually seeing inventory get tight where you live, or are shelves still full? Second, if you had to pick a gold to silver ratio that would make you trade one for the other, what number is it and why? And if you're successful, share your success story in the comments so others can stay motivated. Seriously, that kind of proof helps people stick to a plan when emotions get loud. Now, I know some of you want a simple prediction. You want me to throw out a number, but I'm going to stay honest. In a market like this, numbers are less important than regimes. There's a managed regime where paper can dominate. There's a stressed regime where paper starts leaking. And there's a broken regime where physical sets the tone. We're somewhere between managed and stressed. The evidence is in the delivery behavior, the inventory chatter, the widening spreads, and the positioning games. And if we cross into broken, the price doesn't just go higher, the entire concept of spot becomes less meaningful. Now, that doesn't mean tomorrow is the end of the world. It means your strategy needs to respect tail risk, and tail risk is where silver lives. Now, quick but important, we do offer members-only videos produced by a separate team with more research, and those are only for premium members. If you want the deeper dives, more data, more context, more charts, check that channel membership join link in the description. Also, for the people who keep asking for faster updates during volatile weeks, that premium WhatsApp channel link is there for you too. All right, back to the metal. One of the biggest mistakes people make is thinking higher price automatically fixes everything. It doesn't. A higher price can actually expose the stress faster because it increases the incentive for people to demand delivery, increases the pressure on short positions, and increases the public attention that makes quiet games harder to play. So when you see silver ripping, don't just celebrate. Observe. Watch how the system responds. Do spreads widen or tighten? Do delivery numbers accelerate or fade? Do paper volumes expand or contract? Do physical listings stay available or vanish? Those behaviors tell you more than any commentator screaming about a target. And yes, I still like owning silver even up here, because the core equation hasn't changed. Industrial use is real, supply is slow, investment demand is waking up, and the paper structure is fragile when confidence shifts. Now, could we get a nasty pullback? Absolutely. Markets breathe. But here's the thing. Pullbacks in a structural bull market are often the last chances people get before the next leg higher resets the whole conversation. And when you're dealing with a metal that can disappear from retail channels, I'll just buy later can become, I wish I bought when I could. So do what you want. That's your life. But don't let undercapitalized middlemen scare you into selling the asset you spent years preparing for. Now, I'm going to end the way I started. This isn't about a price tag. It's about a transition. A transition from paper confidence to physical reality. And if you're watching this right now, you're early enough to think, not late enough to panic. Let me know in the comments if you want me to keep covering silver like this as it moves, because I'll follow what you care about. And if you're successful, share your success story in the comments so others can stay motivated. I mean that. Hit subscribe so you don't miss the next update. And remember, I'm here to talk through the mechanics, not sell you a fantasy. All right, take care of yourself, take care of your people, and I'll see you in the next one. And just so it's crystal clear, nothing you heard here is personal financial advice. I'm sharing education and my own opinions so you can think for yourself, do your homework, and make choices that fit your situation.